How to finance your property. Financing your residential rental income property is key to making a good return. And this is something that I've spent 35 years of my career doing. So it's very doable. It's something that we're experts at. So I'm just going to give you a couple of key tips to this. The first thing they're going to want to know is about you. So you have to have a resume, some level of experience to show that you can manage this property that you plan to buy. That would be number one. It doesn't necessarily have to be exactly what pertaining to this, but you need to show that you can do this. It's like having a job interview in a sense. The next would be you need to have enough net worth and enough financial capacity to be able to buy the property. So this is all about evaluating your own credit. The rule of thumb there is that whatever your loan amount is, you should have a net worth that's at least 25% of whatever you're purchasing. So, as a quick example, if it's $100,000, you should have $25,000 cash in the bank. That's kind of the rule of thumb. There's some flexibility there at times, but that's generally the rule of thumb. It makes it easier. The other is understanding the income of the property. This is actually what you're financing. The net operating income, which I've discussed in other videos, is key. Once you understand the net operating income, then you can decide what amortization you're getting, what form of financing you're getting, if you're getting conventional financing or CMCH financing. That will affect the amount of loan you have. And that also affects the amount of money you have to put in. If you're doing conventional financing, the rate's probably something like, at current rates today, it's probably like 6%. But if it was CMCH insured, it would probably be 480. So you'd save money doing CMCH insured. There's definitely a difference. You do have to pay a premium for getting CMCH insurance. That amount, fortunately, whatever that premium is actually added to your loan. And then it's amortized over the life of the loan. It probably works out the equivalent of 10, 12 basis points higher on the overall financing cost. In conclusion, financing your property is how you're going to make money. You have to come prepared with the documentation. You have to come prepared about your net worth. You have to come prepared with all the income and all the expenses and the backup that go with that. And then you should calculate what the amount that your loan can handle. And usually it's 1.2 times or 120% on the debt coverage ratio. And then you choose which form of financing. And generally speaking, if you're 5 units or more, CMCH is actually the way to go because you have a lower interest rate, which allows you to have slightly more loan, which allows you to put a little less money into the property, which allows you to have a higher cash on cash return. It sounds simple. I'm sure you'll be working with somebody that can show you the ins and outs of this. There's a lot of little things that I didn't put in here, but in general, that is the concept, and that's how you finance your property.